housekeeping issues. I don't know how many have joined since I've said this, but we can't hear you. So if you have questions, please use the chat box to ask those questions. We encourage it and love answering your questions. So don't hold back. If we do get too many questions to address at the time, we are reserving time at the end to address more questions. We do have a couple polls that will pop up during the presentation, so that's also another way for us to see feedback and see if what we're saying is getting through. And then also, we wanted to let everyone know we're recording the presentation today, so we'll circulate the recording afterwards and also the slides. These materials are free, so free for you to use. So if you hear something today you think somebody else could benefit from, feel free to forward them or share that information with them. And then just to give a couple of introductions, I know we've worked with some of you for a long time and other people are more new, but just if you don't know, I'm Amanda Vaught. I live in Brooklyn, New York. Before I was a financial advisor, I worked as a chemist and an attorney. And then also with us today is Emily Augusto. Emily's in Chicago. Emily's a CPA, investment advisor, and does tax as well. We have David Vaught. He's in Naperville, Illinois today. He's also an attorney, practiced law for a while, has his CFA, and has been an investment advisor for more than 20 years now. And same with Danielle, also an investment advisor, more than 20 years. She is in Maryville, Tennessee, also an attorney. And anything else about you, Danielle, I missed? I'm sure there's a lot. I'm keeping it short.
Move on, yeah.
Danielle also does tax too with Emily. Mm-hmm. But now I'm going to kick it over to you to let Danielle give sort of an introduction to what we're talking about today.
Thanks for everybody joining us today. We know it's been kind of a crazy year, and all of the information that we're going to talk about today has really come from our clients, things that we've seen that are new or are about to be new, meaning how do we respond to what's been going on, and how do we change or not change what we do going forward in the future. So we don't have extensive notes or really detailed slides. It's really just a guide. And again, like I said, it's based on real questions and real situations we've had with clients this year that we thought other clients would benefit from learning about. Things just keep getting more complicated, and we want to be able to be available to our clients and to anybody who wants to become a client. And I think we're in a unique position that we've all done a variety of things and worked with a variety of types of clients. We're unique that way, and so we just wanted to give this opportunity to share what we've learned, what we're still learning, and get some feedback from you about other things that we need to be working on that we may not have heard about yet. Do you want to do this part, Amanda? You're on mute, Amanda.
Oh, sorry. You want me to? I'll go through
Yeah.
what we're going to cover today. I'm going to start with going over some common money behaviors that we see, and also some tools for setting financial goals. Then we're going to go through our changing approach to investing, and then finish up with some tax strategies. Okay, so this is a little bit about me. Okay, so first I'm going to start with money behavior. And so the reason we want to cover this really is that personal finance is personal, and everybody comes to money from a different background, different experience. And so when you hear generic advice like stop buying Starbucks coffee every day, it's just, maybe you don't have that problem. It doesn't really apply. So one way to get personal is to get into a little bit of psychology about how you view money. Because really at the end of the day, it's emotions that drive money behavior. This is not really a rational thing. It's not, make a budget, crunch some numbers and follow that. It's really behavior driven. And another thing we just want to keep in mind today is that we view money as a tool, and that is a tool to help you achieve your financial goals, help you live your life and enjoy your life. So we consider money to be a tool and not the end goal. This isn't just about how do we make as much money as possible. Okay, so when going through money personalities, the first type is money avoidance. Before I really get into this, there's 4 types. And so as I go through these, I think most people will recognize some of these behaviors in themselves, in a spouse, in friends. And these 4 types are what's considered within a normal range. So there are other money behaviors like gambling addiction and that type of thing. That's more like a money issue. But these are the
We're not talking about that today.
What's that?
We don't go that far.
Yeah, no, we are not psychologists. This is just, informational only. But these are the 4 that psychologists say fall within like the normal range of people. Okay, so the first one here is money avoidance. So this is a personality type where a person has a negative association with money, meaning they view money or people with money in a negative way. They think rich people are greedy, money is corrupt, more virtuous people live with less money. So this can be fine. People like this can be generous. They value relationships and friendships over money, but also can have a negative effect in terms of them undervaluing themselves or turning down job promotions, or if they get money, they just give it away. I can speak to some experience on this. I have a little bit of money avoidance in me. And so I recognized this, and then I dealt with it by saying, oh, I hate paying my credit card bill. I need to create an accountability system. So, I have my husband, he deals with the credit card bill, and then it gets dealt with. Okay, and another personality type that's common is money worship. And these people think money is going to magically improve your life. They think money will solve problems. Money is the goal. And money can make you happy. So positives of this is that people tend to be ambitious and money driven. The cons is that they overspend, or they can become overly attached to stuff. And I just saw this one yesterday in the New York Times parenting section. There was a mom in there talking about being in quarantine during coronavirus, and she missed her friends and her kids missed her friends. And what she did was she went on Amazon and she bought something every day to sort of fill that hole. And I was like, oh, this is classic money worship. She thinks just buying this stuff is going to solve the problem. And maybe it feels good temporarily, but I mean, everybody's struggling when we're not seeing our friends and family. So it's not really filling that hole. And just identifying it and seeing it there can help you address those behaviors. The next one is what's called money status. This is people who link their self-worth with their net worth. And so, this is actually the most common money personality in the United States. So, this is an outward display of wealth, with a fancy car, fancy handbag, huge house, that type of thing. So these people, they enjoy their money, they appreciate quality. I think they probably keep the American economy running to some extent. The cons are, sometimes these people overspend, they, fake it before they make it kind of attitude. And it also can lead to deceit in your relationships with people. And then the final one is what's called money vigilance. These are people who think that the most important thing they can do is save their money. They think they really have to work for their money. They don't want handouts. So the pros of this is that they're great savers. They tend to be wealthier. But the cons is they can get anxiety if they haven't saved enough. They can be really secretive with their money or lie to other people about it. These people also tend to have trouble retiring. They just want to keep working and saving money. Let's see. So now we have a poll. So if you have recognized your money personality in one of these 4 types, I hope you'll let us know. I have to launch the poll, sorry. I'm new at this. Okay, there it is. We'll let the poll sit up for 30 seconds, 1 minute or so. If you don't mind sharing, if you identified with one of these.
I really liked that Amanda had the idea to put this in the presentation because it's something that we have to do as financial advisors, and we didn't have these definitions in front of us. We certainly don't categorize clients, but it helps you to kind of know where the client's coming from and what's going to work as far as planning with a client. And this was kind of fun for us to do as a exercise just internally too.
Okay, I'll let the poll has been open for 50 seconds. I'll let it go up to a minute. So we have about now 5 more seconds if you want to put your vote in. Okay, and then can everybody see the results? So we have a lot of money vigilance people in the audience, which is great, but it's also sort of what you would expect from people who will attend a webinar on financial issues, right? Know how they can save more and be good at it. But and then we have 2 money status, 3 money avoidance. So sort of across the board. And so all of these are considered normal, and you can definitely have more than one. I think on the next slide here, I have a link to NerdWallet. They have a quiz if you want to take the quiz and see what they say your predominant personality is. Okay, now I want to transition into talking a little bit about setting financial goals. So this is an exercise also from this financial psychologist, Dr. Brad Klontz. He said going through this exercise increases savings rates by 73%, which just seems like such a big number, but if it works, it works. So we'll go through it really quick and hopefully it will work for you. Okay, so the first step we want to do is identify a financial goal. So I'll just say for us personally, our current financial goal is my 4-year-old is dying to go to Disney World once the lockdown ends. So, okay, so we'll say go to Disney World for me. And then we want to rate this goal's importance on a scale of 1 to 10. So I'll say, I don't know, it's 11 for her, but we'll call it like an 8. And then we want to go through and rename our financial goal. We want to be specific and start creating a mental picture. So for us, it's go to Disney World in Florida in, December, and really start to picture that in mind, us there. Set a goal date. Okay, so I'll say 2021, assuming, I know it's hard to plan in advance with coronavirus, so we don't know what's going to be going on, but let's just say 21. And then this part is what the psychologist said really is effective, this picturing part. So take your time with this. I won't take the time right now, and really create the visual in your mind of being at Disney World or whatever it is, having fun with your family and your kids. And like I said, we can really enter earlier fantasy land and say our kids are having fun. Nobody's having a breakdown. Nobody has sunburn. No one's hungry. It's great, And then really picture that. And then you can also take the time, if you're a very visual person, some people really are, and draw it, paint a picture, find a picture on the internet and save it on your phone or whatever it is. And then you put this picture in a place that you see all the time, like your refrigerator or your desk at work or the wallpaper on your phone. So it's constantly there and a constant reminder that this is your goal and this is what you're working on. And then the final steps are really to automate your success. This is key. If you just set the goal and then you don't really doing anything about it, you're not going to get there. So you set the goal, you set your date, and then you just make monthly deposits, and then you don't have to think about it. It's done. Next, we're going to transition to Emily, who's going to go through some more examples of setting financial goals.
Hello, everyone. Thanks for attending today. This is our first webinar, so I'm sorry some people are having trouble with the polls, but we'll get better as we learn more about these webinars and how to do them and make them most helpful for you. Okay, so if we go to the next slide, I've put together a little bit of a financial, just kind of an example. I use myself as the example because I thought that'd be the easiest. So my main financial goal is to save for retirement. So I rate that as a 10 out of 10. I've renamed it to be, well, to me, when I think of retirement, maybe this isn't true, but in my mind, I think about it as being on a permanent vacation. So that's my mental picture. My goal date is a bit long-term. So another helpful thing to do when you're setting goals is to break them down into just smaller, more specific goals. For example, max out my Roth in 2020 or save X amount of dollars by 2025. When it comes to picturing the financial goal, since I have this kind of permanent vacation and desire to travel at retirement, I just have vacation pictures on my phone, on my computer. I'm all over the place. That helps me get in that what it feels like to be on vacation mindset. In terms of sub-accounts, I have an IRA and a Roth setup, so that's pretty straightforward when we're talking about retirement savings. And then I think the most important part of this is automating your success. So with the two custodians we work with, Schwab and Fidelity, you can set up automatic transfers from your checking account to your savings account at Schwab or Fidelity or whatever custodian you're using. And you can set it up to be monthly, weekly, whenever you get paid. It's very simple to do. The other part about automating it is if you work with us, we will automatically invest your funds as they come in. And we invest our own accounts regularly with that same insight, knowledge, and all the research we do. You have access to we invest in the same things that we recommend for our clients. Okay, so the next slide, we just have a list of all the different types.
Oh, Emily, I just wanted to chime in really quick. Sorry to interrupt, to say that when we do this part where we talk about rating your goal, I just wanted to say this can be really a helpful exercise for couples. If one person is expecting to retire at a certain time and wants to travel and the other one doesn't want to travel at all, this can be a good starting point to talk about these kinds of things.
Yes, thank you for pointing that out. That's a really good point. Also with the money personalities, maybe one person is very much in the money worship category and the other person's money vigilant, and helps you just kind of meet in the middle. And maybe you don't take the extravagant vacation, but you still get to go somewhere. That's an example. That might happen between spouses. Okay, so the types of savings accounts. This is just a general list of the myriad of amounts of savings accounts that you can use to reach your goals.
We don't expect you to actually be able to read it. It's just, it's really just showing you how many types of accounts are out there and why we think it's good to have help choosing what makes sense for you. Because you might have one of these, you might have four of these, you might have to change from year to year about what you use. And that's just another thing that we do on a constant basis, is trying to keep up with legal changes, client changes, and seeing which of these make sense.
Absolutely. What we would recommend for one client is not going to be the exact same that we would recommend for another client. Okay. And then this last slide here in the section is just a snapshot of a financial goals worksheet. We've put up a download on our website, propelfinancialadvisors.com. And I would just encourage people to go through the exercise and see, where you can do a little better, especially now during these times of economic uncertainty. It's really important to get some solid savings habits down. And if you're already good at saving, maybe you need help for that push to spend a little or, be comfortable retiring, things of that nature.
And I think putting things on paper sometimes reduces anxiety or just helps you get organized. And I know we do that all the time. We always joke about how long our list is every day or what we have going on. And that's just one way to kind of get it out of your head and put it somewhere else.
All right, I think the next section is for David. So did you learn anything about your money personality?
Well, I noticed that some other people had the same problem that I do, and that is they recognize more than one category, at least for part of the time or part of how they're influenced.
Caller.
What?
Oh, that's you.
It's my phone trying to sell me something. But the money worship was the one that I tended to identify with the most. I think this is pretty interesting stuff. There's been a lot of work and writing done in the last few years on a subject called behavioral finance. Investment people didn't used to worry much about behavioral finance. They just they tend to use cookie cutters, is what we call them. This is what's best for everybody. We'll put you in a little category and off we go. We've tried as we've got to know our clients better and work with them more to make sure we're customizing the work we do and the portfolios that we work on in the investment world or on what we do in tax and other financial planning areas to the client's objectives. And, sometimes clients don't just come out and say their objective. You have to kind of have to get to know it as they get to know it. But it's a little bit of a process. So that's why we wanted to mention that. We think it's pretty important. But Amanda, I think we're ready for my next slide. Our plan is to stick with your plan in this current turmoil. The long bull market is over. It started in the stock market in March of 2009. Now the recession was not really over, or the effects and the unemployment of the recession in the Great Recession was not over in March of 2009. But the stock market took off, and it for the most part kept going. It was the longest bull market in history, over 10 years, without significant interruption into a bear market.
Should we show our graph now that we pulled up?
Yeah, if you got it. If we'd have to jump to a different slide.
Yeah.
Do you guys know how to jump to that last slide? There we go. 24.
Amanda's, yeah.
But this is only well, you can see the dates there. The big gray bar is the last recession there. I think you can see the 2010. So there in 2009 is the bottom, and you can see that the scale there shows you at about $1,000. To use a scaled approach, and that's turned into over $6,000 even after the current correction. So that's quite a huge bull market, but it's over. We don't expect that to continue like that. We think it's going to be a new economy and one that's very different. But we believe that we had in most of our clients' plans some sense of caution because we recognize the run-up in equity values, and we're trying to put some defensive character and diversification into portfolios to deal with that. Now, how you change directions, to what extent you want to change directions, is a key question. But the basic idea is to stay the course. We've not been asking people to make drastic changes in their portfolios, but if we understand more about where this market is going and also where our clients stand, we want to make some gradual choices. We think the question has become, that we've heard a lot of, and if you can flip back to our prior slides, is what do we do now? Should this cause us to be more conservative? This could get worse, or it might go on a long time, is where that question comes from. We think it's a very legitimate question. And in other cases, we hear the question, sometimes we hear both these questions from the same person, should we be more aggressive in order to recover? If we've been a little cautious going into this crisis, do we need to be a little more aggressive coming out? Because long-term, the economy is going to recover, markets are going to recover, and so forth. So those are the two questions that we've heard a lot. I think we're ready for the next slide, Amanda. And we think that they're a little confounding. These are, to some extent, head scratchers. We don't think the answer is immediately apparent or that we have all the answers to that question. We think it's going to take a while to understand the new economy and also adjust to this whole situation. Fortunately, we've had some bounce back. So, we didn't end up at the bottom there in late March with everybody. The conservative approach, though, if we can go on, I've got a little too much on this. My cohorts told me, because I tend to talk about Warren Buffett a lot anyway. But our general approach to portfolios is this, and that is to have diversified portfolios starting with a base. And Danielle, I want to talk a little bit about this more, because the indexes that are very cheap and very efficient in some ways have a few problems with them. Many of them, most of them, are capitalization weighted. That means that the stocks that are worth the most in the stock market get overweighted. You have more of them in the index. In other words, if you have the S&P 500, you don't have an equal amount of all of those 500 stocks. You have a lot more of Alphabet and Microsoft and Facebook and Amazon. Those top 5 or 6 stocks are now over 20% of that index. So you're concentrated in that to some extent. But you're also a little bit stuck in the laggards, So if the dominant movement in that index is being caused by a few market leaders and an increasingly smaller number of market leaders, how about the other 400 stocks that are in there? Some of those are suffering big time and not doing well. So there's some drag built into that index. That was apparent when we had the dot-com bubble, and Cisco was the biggest stock in the index. It went down 95% in the dot-com bubble. So even the leaders in these fallbacks can hurt you in those capitalization weighted benchmarks. The smart beta is the adjustment to that. There's still index funds, but they try to focus on a sector of the market, use a quantitative screen to pick companies that are a little different than just every large company. And they also weight their holdings differently, using what they call a fundamental factor, like the amount of dividends that the company pays in dollars. They'll weight them by that cash flow instead of by market value, or weight them by earnings instead of market value. So, Daniel, you want to add anything to that? Because I think we deal with that a lot.
Yeah, I wanted to say that those are, we try not to use a lot of these words with y'all and lose you, but one of those is that these kinds of indexes are quantitatively built. David referenced that earlier, and that just means that their numbers and typically their past numbers are what's taken into consideration to make them a part of that index. It doesn't say anything about the quality of the company and how well it's going to do going forward. And David already mentioned Cisco, and Enron, of course, is another one where it was really popular. It was doing really well, but when it came down to getting audited, it turned out they were cooking the books, and they fell and took the entire index with them. And so we agree that we need to have some indexing. It's cheap. It gives us a chance to follow our target. On the graph that we showed you before, that was the S&P 500. That's the 500 largest stocks in the United States. And it's a basic index, and there are a gazillion indexes, and there are even more types of assets that you can invest in. And our job is to kind of weed through all that noise and look at the quantity, but we also want to look at the qualitative, meaning, is the company actually good? I mean, yeah, it might have been small for the last 5 years, but maybe it's poised to grow. And that's what we like to do about actively managed in that first dot there, is where we choose mutual funds or ETFs that are run by people far smarter than us, who have the time and the energy to travel and actually go sit down with CEOs and CFOs of companies and dig through their books and look for things. And there was back to Enron example years ago, there was a mutual fund that we liked that was run by the family that I've forgotten their name, the Davis family. And one of the things that they said at a conference that I went to in New York many years ago was, we met with Enron and we looked at things and something didn't look right, so they didn't buy it. And that's the benefit of actively managed. And we think that both passive investments through index funds and actively managed funds have a place in your portfolio.
Yeah, and this is also the way that we customize, how much of each of these to use is an important decision. It's going to vary by client. But we do like to add these other things to the index. international equities have been a little weak lately, more than lately, the last few years, primarily because of the strong dollar, because you have to translate those international investments back into dollars to spend them in the United States. And that currency drag on international equities has been there. It won't always be there. It's not always been there. But it does, those companies do open up a larger opportunity set. You know, if you want to buy the best automobile company in the world, you might want to buy Toyota. It's an international stock. There are many examples like that, and there are many opportunities out there, including some in the emerging markets. We like to have some real estate in there, especially commercial real estate that's priced every day, not some hidden thing that you only are able to withdraw your money out every 90 days or every year or something like that. We think those are fraught, non-transparent, and full of fees, usually hidden fees. But publicly traded real estate, especially commercial real estate, gives you a different kind of security, a different kind of cash flow. We like lately infrastructure. We think the classic example of that is a company called American Tower. Their infrastructure is cell phone towers. They've made a ton of money, and that stock has made a ton of money in that kind of infrastructure. Infrastructure also tends to be a bit global because we do a lot of infrastructure in the United States with federal money and state money and state issued bonds, right? We've done a lot of that in Illinois. But in the international area, a lot of infrastructure is done by private companies that build an entire airport and run and own the airport, as opposed to governmental functions like that. So we think there's some diversification opportunities there. Bonds are always important to provide safety. They don't pay much anymore with the low interest rates, but they do provide an anchor in the portfolio. And because bonds are so low, there's a lot more interest in alternative investments that have characteristics a little bit like stocks, a little bit like bonds. Their objective is to try to give you more return than bonds, but less risk than stocks. So those add an interesting thing to portfolios. We don't want anyone to think, though, that doing asset allocation is just the amount of bonds you have, or being conservative is just the amount of bonds you have. Some people say that, but we really think you can achieve those kind of adjustments to portfolios within the equity portfolio. Let's mention Keynes here, Amanda, on the next slide. And Warren Buffett. Warren Buffett quoted him in his annual letter this year. I always go to the annual meeting. It was on the internet this year instead of in Omaha and live. But Keynes really quoted, and let's go on to that next slide. Warren Buffett quoted him, and Buffett believes this very much too, that the compound interest, that's that part in the middle of the slide. I'm not going to read the whole thing. The compound interest part of conservative investment in equities is the reinvestment of earnings, the retained earnings. Let's go on to the next slide on an example that Buffett quoted in his annual report. He said, these are companies that Berkshire owns. Berkshire invests in a lot of other companies in their stock, like American Express or Apple. For a long time, he didn't buy Apple. He should have bought it earlier. He admits that mistake now. But he owns a ton of it now. And Berkshire got $773 million in 2019 from the dividends from Apple, which isn't a big dividend paying stock, but they make so much money and he had so much of it. That's a ton of money that he took in earnings. But Buffett says what's even more important is what are the earnings they didn't pay to us as dividends. $2.5 billion that was Berkshire's share of the retained earnings at Apple. And Tim Cook and the other executives at Apple are taking that money and investing it in new products. They're investing it in new techniques. They're investing it in greater efficiency. That's what's important for a conservative approach to equities. If the companies are doing a good job through their management in reinvesting those earnings, that's what makes that stock worth more money in the long term. And strong corporate management, mostly in the United States, there's some that's not strong on this, and those companies we don't want to have a lot to do with. But strong corporate management in terms of making money is going to compound a lot of earnings that way. And that's a key to conservative management in the stock market. Let's go on to the next slide. We believe this is the key to the new economy and to the more aggressive approach. There's going to have to be change. There is change happening. it's going to happen at an increased rate. I mean, the fact that we're using Zoom today is an indicator of that. But we think this is the aggressive side of the new economy. It's gonna, here we go. We have a good question here popping up. Whether the virus has compounded the impacts of online commerce on Main Street. Certainly, yes, it's the answer to that question. Some of those may be a little bit negative in terms of the use of artificial intelligence to sort of drive the volatility in the market. So the market swings a little more than maybe the fundamentals justify, and some people trying to make money using the market like a gambling. It's like betting. They're going to a casino. That's a negative part of it that's associated with technology. But overall, we think the virus has sped it up. Let's go on to these other details on innovation, Amanda, on the next slide. These are the keys we're looking for. They may be more. We think this is emerging. But we think Daniel's point about qualitative analysis becomes much more important. We're not getting a lot of earnings right now in this recession. So earnings are becoming more difficult to guide the market. Now, future earnings are important. What those earnings are going to be in 21, 22, 23 is really what affects stock prices, and everybody has an opinion about that. But what is going to lead to those earnings is this qualitative analysis of how are companies adding values through this list that I've got here. Expanding market share is one way that's happening. Companies like Starbucks have certainly expanded their own market share in the good morning coffee business, and there are many other examples of expanded market share, Amazon being a classic as well. New markets that are destructive. When I first put that word in there, I think it was Amanda.
Mm-hmm.
Oh, I thought you all kind of got onto me about that. But they're destructive, but maybe they're more importantly disruptive. Companies that find a new way to disrupt the way business is done. Amazon's the classic example. And they were not destructive, however, to Walmart. They were actually disruptive to Walmart. In Walmart, others didn't do this quite as well, who were physical based, retail based. They were disrupted in their business plans and had to adjust to what Amazon was doing and kind of copy what Amazon was doing. That is destructive development of new markets. That's also disruptive, depending on how it affects the other competing companies. Middle class spending power, I think, is just a huge big deal in countries all over the world. Korea and Brazil are examples, although Brazil's a little trouble now. But India is the looming expansion of a middle class today. Because it's so large and because there's a lot of economic growth there that's going to expand the middle class. When people move from poverty, my uncle used to call them dirt poor. When people are in subsistence agriculture or barely getting by or not getting by, they can't spend much money. When they begin to move into the middle class, they do spend money. There are things they want to buy. There's huge pent-up demand. And that drives markets in a really big way. And in the emerging markets, it's driving things in large numbers, because most of the international economic growth lately, and we believe in the future, is actually going to be in those emerging markets. As these people all over the world, whether it's Africa or South America or Central America, or wherever it is, Eastern Europe, these emerging markets are going to be a big factor going forward. Values that aren't fully incorporated in business are many. Sustainability, energy conservation, putting women on boards of directors for corporations hasn't totally happened yet, but all the studies show that when you have different approaches and different patterns of thought or different kinds of collaboration, it actually enhances the value of the management of those companies. There are many value-oriented ideas that are not fully incorporated in business. In fact, businesses tended to kind of shun them aside and say, all that matters are financial numbers. But those values that are being incorporated in business are going to result in positive change, are one of the new innovative factors out there in the markets today.
To add to that, David, I think one of the things that they also need to do outside of all of these is be able to do them quickly, because technology, as we know, is changing so rapidly that if a company can't keep up, somebody will, and you used the example before about Elon Musk. You'll have to finish that example because you know it better than I do, about how they were able to privately basically push NASA out of the way to do something that NASA was trying to do, because they were able to get it done faster.
Yeah, he beat the speed, and everybody kind of thought, oh, Elon Musk, he's a little nutty, and no way will he beat Boeing to develop that new launch system of astronauts to the space station. But he did, and I am fascinated that he was able to take the first stage of those missiles, the booster rockets, and land them back on a barge out in the ocean, standing straight up, instead of just letting them fall and sink into the ocean. That kind of innovation that's done in a timely way is a big factor, Danielle. Timing is really important.
And I would add one more to this, and I don't want to belabor it because we're getting kind of long in our presentation already, but one of the pitfalls of a company is to worry so much about getting from point A to point B and trying to do it as quickly as possible that they'll end up taking out too much money on loan. And we've been seeing this a lot. We talked about this a lot earlier this year, where the interest rates are so low, the banks and the government are practically giving money away and asking you to innovate. But the problem is that a company that has too much debt on their balance sheet is unsafe as well. And that's something that we've been looking at a lot more closely here in the last 6 to 12 months about, well, yeah, it's great that they, I remember David one morning just called me up and he said, hey, Exxon just increased their dividend. And I said, well, how the heck did they do that? And because, oil was dropping through the floor, and they had $40 million on their debt. And it had, quadrupled over the last 5 years with interest rates so low. So it's a pitfall that we try to keep an eye on as well. So we're actually looking at financial statements more often than we might have in the past to see what's going on with these companies.
That's a good point too, Danielle, because there's some negatives in as everybody tries to adjust quickly and adapt new things. There's been a negative trend, I think, in the economy for some time called financialization, which is the overuse of debt and leverage and turning everything into I don't mean to insult the accountants, Emily, but too much of an accounting question, not enough of a business question, too much Wall Street, not enough Main Street. The bookmakers and takers, Rana Fokuhara, I may be totally butchering the pronunciation of her last name, but it's a very good book on that. Or she's pointed out that danger of doing too much that's financial and not enough that's really on the more sound merits of what helps people out in the economy. So I think some of that is related to that overuse of debt by some companies. I'm going to quickly mention these last two. Healthcare is obviously one of these areas. Because there are all kinds of opportunities for treatments, drugs, and techniques that people besides the insurance companies are trying to make money on. And then there's all sorts of entrepreneurial energies. I think Warren Buffett is a great believer in this in terms of the long-term strength of the domestic economy. There's a lot of entrepreneurial strength out there. Much of it's in small business. It's not necessarily investable initially. But those less predictable insights that entrepreneurs thrust upon us, Ben & Jerry's ice cream may be a good example of that. They revolutionized ice cream. That's not a news story, but it's an entrepreneurial story, and those are among the opportunities we've got to watch for. So I think we've gone enough on that. I think do we have a poll question on this, Amanda?
Mm-hmm.
Do we want to do that now or later?
Yeah, we can do it now.
This is where do you want to go? Where do you want to be? Going forward in terms of your own goals and objectives. So we've got time to answer this one. Well, we'd love to hear the feedback of the people here on where they think they are now. Are you going to give them another what? You were a time counter before, Amanda. So.
Oh yeah, it's been 30 seconds. So we've had 71% respondents, so we can give it a little bit.
Are the others that had trouble before? Erica was one of them. Being able to see this poll, or we Just have some people it's not showing up.
You can always just type in your answer if you're not able to. Oh, you can't see the poll at all, so how can they type in an answer?
Oh, weird.
Yeah, we're sorry about that. It basically says, are you conservative, somewhat conservative, middle of the road, somewhat aggressive, or aggressive? So those are able to answer it. We'd love to hear the result. The rest of you.
Oh, okay. I'm going to go ahead
we'll talk to
and
you.
share.
There we go. And for those who can't see it, somewhat aggressive was
The winner.
44%, middle of the road 38, somewhat conservative 13, and a really aggressive 6. So that's an interesting. I'm not surprised at that result from our group. Are you, Danielle?
No, I was expecting more conservatives though.
I was too.
Well, maybe they didn't sign up for the webinar.
Okay, I'm going to turn the.
We still have a couple people telling us they can't see the poll. We don't know why, because other people can see the poll.
Yeah, I don't know.
We don't know what. That's a new one on us.
We'll share the results afterwards with everyone, but I know that doesn't help right now.
But Danielle and I have worked together a long time. We always have a lot of fun. And if we don't have fun and want to disagree about something, we have found that especially Emily is very good at finding the middle ground, and not that we need a lot of calming down, but and you've heard something from her already, and she piped in as she always does. So she's also with Emily worked very hard on doing tax for our clients, or people that aren't Propel clients. And increasingly that leads them into working with small businesses or people that have small businesses that need more financial planning. So that's kind of our transition to the next subject, Danielle. So let her rip.
Mm-hmm. Actually, Emily's up first on this.
Emily and Danielle. Okay, good.
Mm-hmm. You want? Okay, go ahead, Em.
Yeah, we're just going to talk about a few quick tax strategies relating to job loss during the pandemic, some help for small business owners, and then finish up with personal tax planning. So the first slide is about job loss or change during COVID. If you've experienced job loss at this time and you're receiving unemployment income, keep in mind that that is, sorry, I saw a chat pop up. The unemployment income is taxable. So if you're not having that withheld directly from your benefits, you will need to set aside funds to pay your tax bill. The next point is a really important one, appropriate tax withholding. If you've changed jobs, whether you've gone from one W-2 job to another W-2 job or become a 1099 independent contractor, you always need to check in on your tax withholding. If you have started a new W-2 job in the last year, you've probably noticed that the W-4 has completely changed. That is the form where you used to just write in 1 or 0 as your exemptions, and even though it didn't really work, people kind of figured out what worked for them. Now the form, so the IRS has tried to make it more specific to individual households. However, they've really just made it more complex, and then with complexity comes more room for error. So take a look at your pay stubs and make sure the withholding looks okay, or talk to your tax preparer, talk to us. It's really important to you don't want to be surprised in April with a huge tax bill. The last point on here is associated with job loss. If you've lost your health insurance coverage, you may want to look into the marketplace at healthcare.gov and see if you qualify for a premium tax credit. So basically, you just plug in your income and the size of your household, and depending on that information, you may get a certain credit towards those monthly premiums, or you might even get those premiums covered completely. Okay, and then on the next slide, I'm going to jump into talking a little bit about small business owners. And I don't want to go too far into detail on this, but if you're self-employed, a sole proprietor, or even a 1099 contractor, you could be considered a small business owner. Some of these programs that have come up during the pandemic are the Payroll Protection Program loan that was established through the CARES Act by Congress back in March, and the Economic Injury Disaster Loan, which was put into place by the SBA, the Small Business Administration. both are good options to help retain employees, to help keep your business afloat right now, but they are complex. So if you have received any of these loans or you're thinking about applying, I think for the PPP loan is the only one that's still open. Talk to us, talk to your tax professional or a CPA. Okay.
Is it only open till the end of this month, or is it the end of July? I always forget.
So the PPP loan currently is open till the end of this month. You have about 2 more weeks to apply. There's still $120 billion allocated to the program right now. I just read this morning. So yeah, if you think you might be eligible, or you need help figuring that out.
Yeah, let us know right away. Like right away.
Right. Okay, the next slide is just a couple more resources for small business owners if you're experiencing a decline in revenue or revenue uncertainty. As states are beginning to open up, you're not sure kind of how your income's going to look in the next few months. Aside from the 2 loans I already talked about, you can look into an employee retention credit, payroll tax deferrals. There are some other SBA bridge loans and debt forgiveness that they have on their website you can look into. Local business loans and industry-specific grants. I know at least in Chicago, I've seen a lot for the restaurant industry and for the arts. That might be worth some time researching. And finally, and the most important and close to my heart, is tax planning. Just because you have declining revenue does not mean that your taxes are also going to decline, especially if you have any debt forgiveness. That is definitely going to affect your tax returns for 2020. And something to consider. So I think that covers all the doom and gloom. So Danielle's actually been helping people open businesses right now. So
it's been sort of surprising how many people are starting businesses, or as David would say, maybe not. Maybe this is part of the new economy. You've either been laid off or you're sick of working for your boss, and you start your own thing. And we are very supportive of that. Obviously, we love small business owners. We love to help people work for themselves and make that as painless as possible, because God knows the legal requirements from the states and the tax requirements from the federal and the state government are not simple. And if I had any general advice for anybody wanting to start a small business, one of the biggest mistakes that we see made is they pick one thing to focus on first, whether it be a business structure or how they're going to pay their tax or filing something with the state and just throwing their hands up and saying, well, I don't know what to do now. And the thing is, you kind of need to do all of that at once. They're all connected. I hear often people say, well, what if I want to be an LLC? I want to pay taxes as an LLC. And that's not. There are 2 different things. You've got legal requirements and you've got tax requirements, but your legal situation is going to dictate or give you choices on the tax side. And you always want to get bookkeeping started right away. We've got clients who come to us after 2, 3, 13 years in business saying, well, we've just kind of thrown it like this and we just put it together somehow at the end. And QuickBooks costs about $10 to $20 a month to download all of your activity for you. And for the love of God, just do it, because when you get busier, and often small businesses do, they often get busier faster than they expect. Those processes will already be in place and it won't be so painful for you. And if there are any mistakes, it's a lot easier to find them and fix them than having to recreate the wheel and then address a problem. So we always recommend to somebody to get some help up front and make sure you're talking to someone who knows a little bit of all of this. Like us, sometimes I'll get a new tax client who came to me from an attorney who charged them $3,500 to start the business, and they have no idea what they did. And they don't understand how it's going to impact their taxes. They haven't really set anything up. They've just done all this paperwork and they thought they were ready to go. And really they have a bunch left to do, that had we done all that at the same time and made those decisions, it would have been easier. So let's move on, because we're running out of time and I don't want to make people stay on. The other thing that we're seeing during COVID is some businesses that are really getting busier. And it isn't necessarily COVID, it's any small business that happens to have a good year or suddenly takes off after 2 or 3 years. They're just sort of struggling along and they have this issue or a problem of making more money. And that doesn't seem like a problem until we get to tax time. And so if a client hasn't been talking to us through the year and they show up in April and say, here's my stuff, and we say, that's great. Do you realize you made an extra, $40,000 this year? And they're like, really? It doesn't seem like it. I was like, well, yeah, but now you got to pay an extra $15,000 in tax. And then they have a heart attack, and then we spend the next 6 months trying to fix it so that we don't have that same problem next year. So again, that goes back to Emily's point about planning. We can't make taxes go away, but as complicated as they are, there are a lot of things that you can use to your advantage, and the sooner we know what's going on, the sooner we can use those to your benefit. And so we're always recommending to people to stay on top of it, and talk to us regularly. If you've had a big change, let's talk about it. Summer and fall are perfect times to be planning. It's after tax season. You're only about halfway through the year. We have time to fix it or change it or make adjustments before the end of the year. So that's like our favorite time to do tax planning. And lastly, of course, even if whether you're a small business or just a person who works for an employer, any kind of personal changes are going to throw a tizzy in your tax situation, because our tax code, as I've listed there below our little caterpillar, is a ridiculous amount of mess. And the amount of rules we've seen come in over the last, 4 years are incredible compared to maybe the last 20 to 40 years. And David constantly says, yes, the rate at which we're seeing this is astounding. And that's kind of why Emily and I started DW Augusto almost 6 years ago, is because as a financial advisor, we felt like you can't possibly wrap your mind around all of the things that we need to be helping people with unless you have a good base of tax knowledge. And I'm glad we did that then, because it's just gotten worse since then. So the tax law changes have been constant. Personal changes for people. People are changing jobs all the time. It didn't used to be that way. People used to start a job and be there forever. I talked to a lot of my husband's family who's lived around here in East Tennessee, and they worked at Alcoa for 40 years. You don't hear about that much anymore. People change jobs and their situation changes, and it's something you have to keep up with. Budgeting for taxes. We have a lot of clients who go from a W-2 employee to a 1099, and we have to be the bearer of bad news when they haven't been making their payments all year. And now they owe 15% in self-employment tax plus income tax. It's really painful. And so our goal is to try to get people on a monthly, at least a monthly payment schedule that they can keep up with on their personal taxes. And again, avoiding and fixing mistakes. You do not want to deal with the IRS. I can't stress enough how much you don't want to deal with the IRS. It's not because they're mean or nasty. It's because their system is antiquated. They're understaffed. It takes forever to get anything done. I have clients send me a letter in a panic half the time, and then I just tell them, just wait a minute. In a week they get another notice that says something completely different. I'm like, oh, now we get on the phone with the IRS and ask them what the heck is going on. They're just a mess. So the longer you let something go without fixing it, the harder it's going to be to get it fixed going forward with the IRS. And the way you fix mistakes with the IRS is often different than you would expect. So that's something else we run into. People tend to think that if they're 2 or 3 years behind on the payment, they should address their 2 or 3 years ago payment instead. And it's quite the opposite. They want you to take care of this year first, and we'll set up payment plans or do whatever we got to do going back. But we always say, well, let's do this year now. And I think clients are often surprised by that, but that's how it works. So those are a lot of things that we know that we can help you with. And I don't remember if I have another one. I think I'm done. Yeah. Is Emily doing finals?
Oh, whoever wants
You want me to do it? I don't remember.
Me either.
Our final thoughts are just that all of these things intertwine. That's why we all like doing all of these things. We like that we all have a different background and way of looking at things, and we think that's to our clients' benefit. Your relationship with money or your money personality has a lot to do with how you address your situation and how we learn how to work with you and make things work for you. Your plan is dependent upon not only your earnings or your ability to spend, but your ability to save. Remember that there's a good third of your life where you may not be working, but you still have bills. And so we encourage you to continue to save during the periods of time when you have the money coming in. I always tell people, if you think you're broke now, wait until you don't have any money coming in at all. That is something you really have to save for. And understanding your needs and risk tolerances, and obviously tax planning is a huge part of that. People pay taxes anywhere from 10 to 40% a year on their income, and that's not a small number for anyone. So getting ahead of that and knowing where those numbers come from or where we can reduce them is vital to your savings ability. Somebody else can talk now.
Well, this is just an overview about what we think we bring to the table that's different from other financial advisors. I won't go ahead and read through it all, but yeah, here's all the places you can contact us. Our personal information was also on each of our bios that we will send out. We're online, we're everywhere. Amanda's doing an awesome job with our social media right now. There's all kinds of different and new articles and all that. So thanks for coming. And we didn't really leave a lot of time for questions. So,
but we can stay on and take them for anybody who wants to stay on and ask questions.
And otherwise, send to us anywhere, and we'll address them that way.
We have a final poll too.
Do we?
Yeah. Thanks, Leslie. For those of you who can't see the poll, the question says, when it comes to tax planning, I'm 1, flying blind and hoping for the best. 2, pretty sure I know where I'm at. 3, checking my situation at least once a year. And 4, working with my tax planner routinely.
Didn't we have a suggestion that if you're on full screen, that works better?
Yeah, Derek said that if you are minimized, that you won't see your poll. Nobody has any questions?
That just means they're going to call us and email us.
I'll
Yes,
keep the
of course
poll
you can do
open
that.
for another 10 more seconds.
Okay.
If anybody else wants to. I see that Rich Cullen raised his hand.
Oh, okay. Can we put him on? On mute so he can just talk?
I will try.
Oh, good. 53% of our people are working with a tax planner routinely. That's so nice to see. Can we hear Rich yet?
I had to stop screen sharing.
Oh, okay.
Okay, Rich, I think, Rich, you have to, here, you're unmuted if you want to ask your question out loud. Or maybe you have to unmute yourself.
I unmuted now.
Oh, okay, there you go.
It's not related to what we're talking about, but is that polling feature part of Zoom, or is that something separate that you set up?
Oh, no, it's through Zoom, the polling feature.
Okay, cool. Because I use Zoom a lot for what I do. I didn't know that was available.
Bye, Leslie. Thanks for coming.
We've got another question
Thanks,
here.
Amy.
Mary is sitting in if you guys want me to answer it.
Yeah, I don't see Mary's question yet.
She typed it. It's in the Q&A. And the question
Oh, okay. It's in a
is, do
different
you have any
spot.
concern about the financial institutions collapsing? I'm answering live. Yeah, I think that's the financial people have a word for this that doesn't make a lot of sense. They call it tail risk. They say, are there some risks that normally people don't consider much, but boy, if they happen, they're considered unlikely but dire. And this is the kind of question that is dire. If we have financial institutions collapse, it's going to upset the apple cart pretty much for everybody. We came really very close to some of that in the financial crisis of 2008, 2009. Certainly, if you worked at Lehman Brothers, you felt like your financial institution you'd worked in for most of your life collapsed. And if you owned a bunch of Lehman Brothers bonds and they went into bankruptcy and you got zero, you felt like that. But that financial crisis was in danger of spreading to other financial institutions and becoming a cascading collapse that led to other bankruptcies and shutdowns, and off it went. But who really rescued it, besides the stimulus both President Bush and President Obama supported and implemented, was the central bank. The Federal Reserve Bank stepped in to provide liquidity to the markets and to all those people that were on the verge of collapse. And even though they let a couple institutions like Lehman Brothers collapse, they stopped the collapse. The other thing that strikes me about the history of financial collapse is our Federal Reserve Bank has been around for over 100 years. It's not collapsed. But we do have one historical situation where central banks clearly did collapse in major countries, and that was right after World War I. There's a great book on this called The Lords of Finance. I can't remember the name of the author, but literally the British, the French, and the German central banks all collapsed after World War I. They collapsed under the weight of excessive expenditures for the war. And essentially their gold, there was a lot of gold standard at that time, the gold left those central banks. A lot of it ended up in Fort Knox. A lot of it flowed into the U.S. system because the U.S. system remained resilient and strong. And it's really the period during which the U.S. dollar became dominant, because the British pound had been dominant before that period of time. So we do have some history of that. Most people have heard about how that affected Germany with the massive inflation that resulted there after that collapse. And of course, they were in the post-war period, being hurt by the treaty as well. So it's hard to say this can't happen, but I don't think we're headed there. The most credible concern that I have heard about it was in the Wall Street Journal by Phil Gramm, a former Republican senator from Texas, who was very active on one of the committees. I think he was chairman for a while of one of the key financial committees. I don't remember the name of the committee in the Senate. He got pretty knowledgeable about this whole subject, the strengths of financial systems. And I think he became a lobbyist then, as so many of those people do, and stayed involved in that. He wrote a pretty interesting op-ed in the Wall Street Journal a couple of weeks ago, where he said that we are going to get inflation, and we're going to get a lot of inflation, because the current people at the Federal Reserve think they can put a lot of liquidity in the system. And because we didn't get inflation in the financial crisis of 2008, 2009, we're not going to get it now. That's kind of the assumption, he says, is a faulty assumption, according to Phil Gramm. And he gave some reasons, some very technical reasons for that, many of which had to do with paying interest on reserves that banks have to keep with the Federal Reserve. Those used to be non-interest bearing. Now they bear interest. And he said the way that they adjusted the financial system to do that created a greater risk of inflation as the overall size of the debt goes up. So I think the answer to Mary's question is no, we're not greatly concerned about it, but we are concerned about that potential for future inflation. You want to add to that, Danielle?
Yeah, I mean, you kind of skimmed over the part where the United States government has a printing press and they're using it. And I don't just say that myself. I went to a conference several years ago. An economist was giving a talk, and it was really good. And that's what she said. She's like, we'll never have a crisis like that. They'll just make more money. They also have the ability to remove some of that money from the economy, as they do, where they're buying bonds. They're buying bonds by the truckload right now. It's sort of insane. And it's one of the concerns about the European Union is that those individual countries have given over their monetary systems to the European Union, and they can't just print money for their countries. And that may be why, when people say Europe isn't as strong as the US, they've kind of lost some of their independence on their monetary system. And so it's a benefit to us when the dollar is roaring, but it throws things out of whack, and we prefer things to be more balanced. But no, I'm not worried. From just a human psychology or sociological point of view, I think human beings as a whole, as awful as they look when you watch social media too long, we have a lot of smart, innovative people who won't let this fall apart. And I guess I'm not worried. We've come through some really awful things before, and the Great Depression was incredible. It was 10 years of vast unemployment and people getting in line to get soup, and we've not been there since. And I don't think we will. We were talking about inflation, and I guess I'm not worried about it because nobody spends money like Americans. We're amazing at it. We can spend it like crazy. I guess I'm not very concerned about it overall. I don't know if that answers all of Mary's question.
Well, it's a complex question, and the answers are certainly complex. Mm-hmm. Maybe what we said doesn't do them complete justice, but you kind of have to look over your shoulder a little bit because that what the financial people call tail risk. They're talking about some unanticipated horrible event, and a financial collapse of that type would be that kind of unanticipated thing. I just got a note back from Mary. She's reading Lords of Finance right now. I'm glad she is, because it does talk about, Danielle just made the point that people are smart. They figure things out. Well, those central bankers in Britain and France and Germany after World War One did not meet that criteria. There was a lot of personal failure there. And
Well,
that's
they
a
have
very
never,
good book on that.
but nobody's ever done that. The other thing is nobody's ever done that before. I mean, Germany was still only like 30 years old as far as a country is concerned. They were still babies at this, and it hadn't happened before. And current economists have the benefit of hindsight. And if any of them are reading their history, and I know some of them are, they learn from it. And so I'm glad you're reading Lords of Finance, because I have to read fiction at night. I do too much of this during the day.
Yeah. The interesting part about that, though, Danielle, in that book, is the Great Britain fail. Great Britain really did. The pound sterling was essentially the international currency before World War One, not the dollar, and they won the war. And it was so devastating, and it was such a strain on their financial systems that they had a financial failure in Great Britain too, even though they won the war. So again, that was 100 years ago. We don't think we're going back there, but it's something to know about. And I'm no great fan of Phil Graham, to tell you the truth, but some of the things he did when he was in the Senate, I didn't like. But when I read his article in the Wall Street Journal, he was one of those voices of reason you're talking about, who knows something about this, and was, he wasn't raising a gloom and doom flag. He was raising a knowledgeable concern flag. And I think we should listen to those people, at least so we know more about it.
Did we get those poll results, Amanda? That last one you put up? Did I miss it?
Yeah, I launched the poll. It's been open. I can just close it, and then I think we can wrap this up. I'll share the results with everyone.
Well, look at the two highest answers there. That's really interesting.
Yeah, that's good.
For those of you who can't see it, I could improve my planning process one out at 63%. And I need to save more came in second at 50. And, not totally far behind. I want to better understand my investments at 38. So nobody said they were doing an excellent job on their own. These poll results are pretty interesting, I think. I'm not greatly surprised by them, knowing some of our clients and people that answered this, but I still find these numbers interesting.
Yeah.
Any other questions before we let everybody go? Thanks for coming. I hope it was helpful.
We should also add, if there's any topics you'd like covered on future webinars, to please let us know.
Yeah, I mean, we could certainly talk about any of these things for a whole hour, and Emily's joked that the new W-4 form could be an entire seminar by itself. I mean, we've listened to several seminars on these subjects ourselves, so yeah, we know there's plenty to learn. Anybody else? All right. Thanks, everybody.
Have a good summer, everybody.
Thank you.